Good morning and thank you for joining us for today's free webinar, Startup Mistakes, What to Avoid and How to Succeed, with Gadiel Morantes, Partner for Early Growth Financial Services, and Ryan Johnson, Controller for Early Growth Financial Services, in conversation with Emily Levin and Ashley Bennett, attorneys for SBL Counsel. My name is Jenna Cornell and I will be your moderator for this webinar. This presentation will run about 40 minutes. If you have questions as we go through the presentation, please feel free to enter them in the question field or tweet them mentioning @earlygrowthfs and using #startupmistakes. We will answer questions as they come, and we'll have a Q&A at the end for any that we don't get to throughout the presentation. If we run out of time, we will follow up with an email after the presentation to make sure all of your questions have been answered. The video for this webinar will be available on YouTube following the presentation, and the slides are available on SlideShare. Links to these will be included in the follow-up email you will receive after the presentation. Gadiel, Ryan, Ashley, and Emily have a lot to cover today. We want to make sure to save time for answering your individual questions, so let's get going. Good morning, Gadiel.
Good morning, Jenna, and good morning, everyone else who's joining the call. Thank you very much for joining us today. Really look forward to talking about startup mistakes and what to avoid and how to navigate the startup landscape. So to kick us off, a little bit about Early Growth Financial Services. We work with many early and mid-stage companies throughout the country. We provide them with accounting support on a part-time basis, which includes tax preparation and consulting help, producing 409A valuations, day-to-day transactional accounting help, and CFO consulting services. We have over 300 active clients with a presence in 9 US markets. Our staff consists of 20 CFOs with varying backgrounds, all having worked with a number of venture-backed technology startups. And a number of our controllers, senior accountants, and bookkeepers are also part of our organization as well. It really allows us to start early with our clients and grow with them. But enough about EGFS. Let's pass it on to SBL Counsel.
Good morning, everyone. My name is Emily Levin, the managing attorney at SBL Counsel. We are a transactional boutique firm with an emphasis representing companies seeking financing for their businesses. We regularly assist clients in transactions involving sale of assets, sale of stock, mergers, joint ventures, licensing, strategic alliances, and other business combinations. Our practice also consists of serving as general outside counsel to companies. We work with a lot of tech clients, and we welcome the opportunity to be here today.
Hi everyone, this is Ryan Johnson. The goal of this webinar is to explore some of the most common mistakes and oversights that we see negatively impact our clients so that you can learn from them rather than live through them. During today's webinar, we'll explore mistakes that can take place on both the financial and legal side of your startup. So things like fundraising blunders, cash management, choosing a corporate structure, and protecting your company's intellectual property, to name a few. There will be opportunities for everyone to ask questions. As Jenna said, please feel free to write those in the control panel along the way, and we'll make sure to get those answered. But at a high level, these are the topics that we'll discuss during today's call. That said, we can move forward to the next slide.
Hi everyone, this is Ashley Bennett at SBL Counsel. Something that is very important to think about are the common predicaments that you face as a new business. And it's very important to strategically allocate your resources. So on the slide, we kind of lay out a few problems that you face as a new business and the solutions that we suggest. So the first thing that comes to mind is your allocation of resources with your legal documentation. What's very important is that you find someone that you can work with that will help you gradate each stage of your legal protection. For example, it's important that your attorney will spend the time to understand the dynamic between you and the other founders, because it is important to make sure that the documentation efficiently governs the relationship between the founders. The second thing is financing. You need to go out there and raise money, but it's kind of a chicken or the egg situation. How do you attract investors with the right legal documentation? So the other important thing when selecting legal counsel is to make sure that you're working with someone that understands the financial landscape and can efficiently navigate you through your first round of angel investment. The third thing is that when you're working with an attorney, it's important that you have a good relationship with that person and feel comfortable communicating. You want someone that will spend the time to gather, personal knowledge about your business and your goals and give you the attention that you need. And
I'll jump in here on the lack of preparation slide. So first I'll touch on some of the kind of the financial side of the house. I think business planning and forecasting are very, very important pieces of your startup's foundation. So as far as business planning is concerned, really being able to understand your market and your customer demographic from the onset can be critical to your company's success. So this kind of business planning and optimization step is something that should be done at the onset, when you're still in the ideation stage. If you're looking to move forward with this idea and with this startup, you certainly want to dig deeper on the business planning side of the house and make sure you understand your company's strengths and weaknesses and the direction that you're looking to head and how you're looking to grow. Similarly, with forecasting and forecasting your expenses, forecasting will one piece, it will be a tool for you to go out and raise funds. It'll be kind of the future story that you're telling and why your investors should invest in that story. But it's also an opportunity for you to build kind of a company roadmap or an initial roadmap, and then periodically check your actual performance against that roadmap. So that being said, when you're forecasting revenue, and especially when you're forecasting expenses, you want to remember to be conservative. So you want to make sure that you're realistic. You want to make sure that you don't overlook any significant expenses or anything material, because you really want this to be as accurate as possible, and you want to be able to base your forward-looking decisions on this business planning and on these forecasting documents that you've created to ensure that you're heading in the right direction, to ensure you aren't overspending or underspending in any particular area that could impede your company's growth. That said, I'll kick it over. Yeah, go ahead, SBL with selecting.
Thanks, Ryan. To touch on the legal issues that are raised by this slide here, obviously a fundamental question and a threshold issue that all new businesses face is setting up an entity. There are a lot of things to take into consideration. First of all, when do I go ahead and form an entity? Do I do this when I'm a single founder, or what are the types of incidents or circumstances that may prompt me to want to form an entity? So generally the things that come up, to the extent that Ryan touched on, you've got other founders that you are working with and you put together a team, that's generally a good time to set something up. To the extent you're hiring employees or third-party contractors, developers, anyone that you're contracting with in the outside world, extent you're developing any intellectual property, or launching a product. So there are a number of considerations whether you want to form as a corporation, as an LLC, and it's very important from the onset to undertake that inquiry and examine the type of business that you're going to have, the tax consequences, and how best to approach that structure.
And I think Emily, on that point, just wanted to plug in a little bit here. We often see companies formed as LLCs to start and then converting them into a C-Corp down the road. Can you tell us, maybe a few reasons why they would go through that exercise?
Well, the LLC is sometimes, at least for businesses that are starting off, it's a little more flexible and it's a little more fluid. So, there's reason for that undertaking to begin with. From a startup perspective, however, we generally encourage our clients, especially those in the tech sector, to just proceed initially, go straight to the corporation. It is uncontroverted that investors are still much more comfortable in the corporate structure and in the Delaware corporate structure at that, due to the robust nature of the Delaware Corporations Code. And when you're starting off a business, you want to make it as easy as possible for people to give you money. And so, while you can effectuate the conversion from the LLC to a corporation, generally it's a more efficient process to the extent that you know that you are going to be seeking outside third-party funding to proceed initially with the Delaware Corporation, as it's a tried and true method and framework that most people are comfortable engaging in.
Yeah, thank you for that. We actually see that quite a bit on the accounting side, where investors are ready to pull the trigger on investing with a company, but have to wait for that conversion to happen just because they are more comfortable within a C Corp. And that can sometimes translate to having to file your tax returns twice in the course of a calendar year. And so, seeking out that legal advice and frankly some accounting advice as you're creating your organization is key to do that up front. And that kind of goes to the next bullet, which is selecting your business partners. This is a very important piece of what you need to do as founders as you're creating your entities. Obviously, legal is very important in this regard. You can go to some larger law firms and potentially get some fees deferred on setting up your organization, but is it really worth doing that at quite a bit a higher cost? Whereas you can partner sometimes with some of the smaller firms that, frankly, you'll get more attention from them, or have a more senior person working on your, working with you as a client. So looking at it from a legal side, legal partners are very key to any new organization and company starting out, as well as your banking partner, accounting partner, and then your human resources providers. Each of these can add values in very different ways and really help your organization grow and scale. And also finding the right partner can really help you save time and money at the end of the day. So leveraging and finding the appropriate folks that are, whether they're in your space. If you're a technology company, then it's important to have technology bankers, or at least folks that are familiar with that on that end. If you're going to be hiring employees and putting an infrastructure in place that way, having a payroll provider and an insurance provider are also very key to any growing organization. Obviously, on the accounting side, having your books set up correctly from day one will help you save some money and time as the company starts to grow, potentially generating some revenue. Having some type of infrastructure in place is pretty key there. So, for an example, we work with many tech companies, and from day one, it may not be worth their money to hire us. However, a little bit of guidance here and there is something that we're more than happy to provide, just so that correct infrastructure is in place, so you're not having to deal with that down the road. And also leveraging your partners for potential introductions, or basically leveraging their network as well can be really key. And many providers, I know SBL Counsels this way, and we very much act that way, where many of our clients do leverage us for the relationships we have, so that they don't need to go out there and try to figure out who the best providers are in their space, and who the best partners are for them. So we can help out in that way, and all these service providers can in certain aspects. So with that, I'll pass it along for some IP talk.
Sure. Thanks, Gadiel. I can't emphasize how important IP is, especially from the onset. Investors are looking at a few key things. They're looking at you as founders, and they're looking at the IP. And you really need to make sure that ownership of that is appropriately secured. We deal with companies that a lot of time that haven't taken the right precautions, from the beginning, and you wind up expending significantly more resources trying to remedy a situation. The problem with IP is it's expensive. There are just a lot of out-of-pocket costs that you have to outlay for trademark protection and patent protection that are unavoidable. And so, you want to make sure that you do the appropriate searches and make sure that, the name that you are about to invest in and brand yourself under and develop business goodwill in is available, is non-infringing, and that it is, suitable for, for development and for applying your resources to. So you'll want to make sure that you've got your trademarks to the extent something is patented, to make sure that that process is undertaken and that the appropriate agreements are in place with respect to the founders to make sure that the intellectual property effectively gets from them into the company, because that's really what investors are putting their money into. So you need to be able to take steps in the beginning to see a few steps ahead and take that into consideration when allocating your resources.
And just a reminder, if anyone has any questions, feel free to enter them in the question field as we move through the slides. We're more than happy to answer any questions as we go through the presentation.
I will jump in here and tackle the accounting side of this slide before passing it off to legal. So I want to start talking a little bit about valuations. When it comes time for your first valuation, often called the 409A valuation, price shouldn't be your only consideration. So you want to make sure that you look at the firm's reputation and their domain knowledge, and make sure that they're the type of vendor that makes sense for your company to work with. Also, when it comes to a 409A valuation, important to understand that the per share valuation that you're going to receive as a part of this exercise will truly dictate the amount of your company you sell for each dollar that is invested in any particular round. So an important part of the business, an important part of the fundraising process. I'm going to jump to funding objectives. We're all huge believers in milestone funding. The money you raise should be adequate to reach that next big goal, whether it's building a prototype, hiring a CEO, or potentially bringing your software or your mobile application to market. You want to make sure that you don't run out of money before you reach that milestone, but you also don't want to give up more shares than needed in any given round to reach those milestones. So it's really important that you find a balance. And looking back towards earlier slides and thinking about forecasting revenue and expenses, that becomes an incredibly important piece of this fundraising exercise as well, because that's truly going to help you know and understand how much money you need to raise, how many dollars you need to actually satisfy that milestone. And that milestone is what you're going to sell to investors when you're raising a round. So it's important that you reach that milestone in order to proceed to additional rounds and maintain your investors' confidence. Finally, thinking about investor management, it can be really hard to or difficult to turn down money, but you want to keep in mind that you're committing to oftentimes a long-term relationship with your investment partners. So you want to ensure that you guys are really a good mutual fit for one another. And then when kind of selecting or bringing in investors, this is also a real great opportunity for you to bring in strategic investors. So people with deep domain knowledge or relationships in your market who can have a high impact on the growth of your startup. That said, there's a couple points on here that I'm sure would be nice to have legal color on. So maybe we want to jump in and talk a little bit more about funding structure and negotiating terms.
Sure. Thank you very much, Ryan. When you are approaching the fundraising stage, it's very important to realize, where you are in your stage growth of your business. So in the initial stage, you're probably dealing with angel investors. And the terms that you are going to be negotiating with an angel investor are very different from the terms that you would negotiate with an institutional investor. The common way to raise money when you're dealing with individuals is to do something that's called a convertible note. And a convertible note is a really just kind of a promise that you are going to go out and use the funds received to grow your business. And when you are able to raise institutional money, that note will convert in, and that angel investor will get the preferential treatment that the institutional investor gets, but with a discount. So they're taking a risk by giving you money to go out and grow your business, but they get a great benefit when you do grow and are able to bring in the larger funds that an institutional investor, such as a venture capitalist, would provide.
The great thing about convertible notes from a practical perspective is that they're rather cheap and they're rather easy, and they avoid any kind of valuation. So, when you're looking again at allocating your resources being legal as well, you want to figure out, okay, well, how can I get money in the door in a relatively painless way? And convertible notes are a great way to go. You need a term sheet and a purchase agreement and a note, and you've got 2 years to use the money and certain milestones for a financing that will trigger a conversion. So to the extent you're raising $500,000, that's a very effective tool for you to use. A Series A is obviously a lot more complicated with the preferences, conversion liquidation preferences, and protective provisions that are afforded usually to preferred stockholders, and it allows you to defer that process, which is timely and can be costly as well, to a later date when you've had some time to build up some value in the company, get some traction, get some revenue going, and it allows you to further delay that valuation of the company, which is not necessitated by a convertible note, but is necessitated by a preferred round, whether it's AA, whatever you may want to call it. So it allows you to build value in the company and increase the price at which you can sell the capital stock of your company.
Fantastic. So we can move on to the next slide. So some of the financial issues that businesses come up with and basically need to navigate early on. So Ryan touched on pretty much each of these, but we just want to do a little bit of a deeper dive, and Ryan, by all means, jump in when appropriate. But 3 of the points that we really want to call out are cash management, checks and balances, and cash burn. So it's this is your company's money, this is your company, and you really need to make a concerted effort on making sure you know where your funds are going. If you have received an investment and the money that you have is from an angel investor or even a VC, knowing where that money is allocated, knowing where it's being spent is key, and something that they're going to want to know about. So having a system in place, an accounting system in place to track all that's very important. On the cash management side of things, it's just making sure that you're tracking every dollar, putting checks and balances in place so that there's if somebody's writing checks for you on behalf of the company, that somebody else knows about it. And then managing your cash burn, just knowing what type of runway do I have within my organization? Do I have employees that I'm paying them month over month? How long is that runway going to be if I go at the current rate with potentially 0 revenue or a small amount of revenue as I start to grow? One of the key messages that I end up hearing from a lot of the entrepreneurs and founders is they're always in fundraising mode, because at some point your money will run out unless you're generating a healthy amount of revenue. So it's just important to keep tabs on that internally as an organization. Ryan, did you want to touch on any of this?
I think you hit the nail on the head. I mean, I think one thing that I can never say enough is, Cash burn is something that you really, really want to stay on top of. Make sure that you've got some sort of system to track the money going out the door. You know, the number one reason you see startups fail or, you know, close down is because they run out of money. It's not because it was, you know, a great idea or they didn't have a great executive team. It's because eventually they didn't have enough money in the bank to keep the lights on. So making sure that you're in good shape and you understand how much cash is going out the door on a month-to-month basis and how much, you know, how far that's going to get you, it's critically important. It's something that you know, any founder, any CEO should have real-time insight into at any given time.
Fantastic.
So we'll jump into infrastructure, and I think it makes sense to look at it from a few different perspectives. Ashley or Emily, did you want to start with the legal side?
Sure. You know, kind of going back to what I touched on earlier, I can't emphasize enough how important it is to set up a company with the right infrastructure. You know, when you're, you know, the purpose of all of this is really to facilitate an investment, and you know, to the extent you're buying anything, you want to know what it is that you're buying. And when an investor comes in, you know, they're going to want to understand, you know, what it is that they're acquiring a right in. And, you know, so to have the proper structure and the proper setup so an investor can have the confidence and the surety as to what they're purchasing, you know, that is, it makes things easier for them to make a capital commitment. So you'll want to not only have the entity set up at the proper governing documents, whether it's bylaws and initial actions for a corporation or operating agreement for an LLC. You'll want to make sure that, you know, the founders have been issued their stock in an appropriate manner, which is usually pursuant to a restricted stock purchase agreement. Appropriate vesting schedules that are in place so that investors have confidence that the founders have an obligation and motivation to stick around for a certain period of time in order to make their contributions, you know, to the company and to grow the company. That the company is properly capitalized, the stock has been issued appropriately. Again, it's like, you know, buying, you know, they want a title to a car, and they want to make sure that, you know, they are in fact purchasing what they're purchasing. There's compliance with appropriate securities laws, and proper reps and warranties and disclosures are made to prospective purchasers. So, you know, there's a good deal that is involved in getting the infrastructure set up, but, you know, there is a system in place for it. And, you know, I think by working with the tech community closely, you know, the best thing we can do or a law firm can do is to give you something that is workable and doable within your means, that gives you the infrastructure that is readily available for you to be able to go out and procure that investment.
And to add on that a bit, the reason of having a corporation set up or LLC from the very beginning is that you want to have that layer of protection. An LLC and a corporation provide liability protection. And when you start a business, you want to start actually acting through the business alone. So when you have your initial expenses, it's important to have a bank account through your business and make sure that you keep everything separate. Because if anything does happen and someone does take legal action against your business, it will be scrutinized, and it's important that, you know, you've acted customarily within the scope of your business, so that all your finances are separate, and that you've kept, you know, proper corporate records. So in order to do that, you need to have your business set up from the beginning.
I'll jump in and talk a little bit about accounting and finance infrastructure. And so I think I really want to hit on some of the core, or the basic infrastructure, you know, when growing your startup, some of the critical pieces. And I think probably a rational place to start would be with the accounting database. So on one of the prior slides, we talked a little bit about cash burn, which again is incredibly important and something you want to have good insight into. And in kind of one of the most efficient ways to do that is by having a solid accounting database or accounting software solution in place. So at the early stages, I don't think you want to spend, as a founder, CEO of a startup, your opportunity cost is very high. That being said, I don't recommend you spending a ton of time tracking all of the ins and outs of your bank account in a more robust accounting solution, like say QuickBooks Enterprise, or some of the more kind of robust solutions. But I do think it makes very, very good sense for you to use kind of a less robust solution, even things like Xero or Mint or your own Excel tracking sheet to make sure that you have good insight into the cash that's coming out the door every single day. So I think on a, from a near term or an early stage perspective, make sure you have something in place that makes your ability to track and your visibility into cash burn easier and more efficient for you. And there's a number of solutions out there. Then going forward, as operations and transaction volume pick up, you may also have new investors that have certain financial reporting requirements. You're going to want to engage one of those more robust accounting software solutions, such as QuickBooks Enterprise, a system that can really do it all and also help you or facilitate the generation of financial reports. That'll become really critical for you down the line. It'll be really helpful from a management perspective to have, real-time insights into your month-over-month performance so that you can base business decisions upon that performance. Some of the other accounting and finance infrastructure to be aware of is going to be things like banking, which Gadiel will talk to you about, but also payroll and taxes. So one of the pieces of accounting infrastructure that you can set up right off the bat, provided that you're hiring employees, is getting a good payroll partner in place. Withholding taxes vary from state to state and on a federal level. There's really just a lot going on when it comes to payroll, and it is very difficult for someone who isn't highly experienced in this realm to navigate themselves. So look toward payroll partners. There are a number of other solutions out there, the ADPs, the Paychecks of the world. Those types of solutions, they'll save you a lot of time and they're relatively cost effective, but most importantly, they really help take over the administrative burden and also the compliance risk of having employees, W-2 employees on payroll. They'll make sure that the appropriate annual and quarterly filings get made on time and that the withholding taxes are paid on time, because payroll taxes can be a real big issue if things go unaddressed. Finally, I want to talk a little bit about having a good tax partner in place. At the onset, I've seen a number of young companies who didn't deal with their taxes proactively, and it becomes a difficult and expensive issue to address. So having a good CPA partner in place who can help take care of your federal, state taxes, and even give you guidance on things like sales tax and business licenses and business property tax. California can be a pretty difficult tax jurisdiction to navigate, especially as a business. So having a good partner in place in that respect can be very helpful. Gadiel, you want to talk a little bit about banking infrastructure?
Yeah. So one of the biggest mistakes that I end up seeing startups who work with us is not having a separate business account for your company. So once you're along the roads of incorporating your organization, whether it's an LLC or a C-Corp, whatever it is, always make sure to open up a separate bank account, drop some funds in there, and try to manage all your transactions for the company through that. That's one of the key takeaways here. But choosing the right partner, we discussed this a little bit earlier, but choosing the right banking partner can really make a difference for you. A lot of entrepreneurs that I meet with tends to, they've got a personal account at their bank on the corner and they just go open up a business checking account there. But is that really going to add value to their organization as you start to grow? If you're, if you're a company that eventually will take on some outside investment and potentially take on VC money down the road, then having a banking partner who's familiar with your business, or at least the space that you're in, and then also having relationships with the venture community can be key. One of the reasons is that they can actually introduce you to potential investors for your company. And then following that, many of these banks, specifically in the tech sector, will actually help out by providing some venture debt to your company, which can be a huge benefit, because frankly, taking on some venture debt can be a cheaper route to go versus giving up equity in your company by taking on additional VC money. So that can help you extend your runway a little bit and potentially get you to a level of profitability, or at least generating more revenue on a business side of things. But going back to the key takeaway on the banking infrastructure is, A, setting up a separate business account for your company as soon as you can, and then trying to navigate that and finding the right partner when you do that. And that's that's an area we can definitely help with and recommend some banks, and SBL can also do that as well. So passing the baton on for HR infrastructure.
Thanks, Gadiel. As Ryan said, California is treacherous waters to navigate tax-wise. Equally treacherous is the employment landscape here, especially for the nascent business. As everyone knows, California is very pro-employee, and while setting up a business, you need to be fairly careful. One of the pitfalls I've seen young companies fall victim to, are employment issues. You get a notice from the DLSE. You've got a former worker who files for unemployment. A disgruntled worker reports something to the IRS or EDD. Someone's looking at the tax returns. So California is really cracking down on the distinction that people make between employees and independent contractors. And so it's important from the onset to examine those relationships, properly categorize them, and properly document them. I mean, the threshold issue is usually whether the principal has the ability to control the details or manner and means in which a worker performs services. And so being able to properly categorize and have the right types of agreements in place to give credence to that type of relationship and how they appropriately should be taxed is paramount to the business that's starting off.
Next slide.
Before we move on, we have a question from the audience. Ryan, it relates to what you were talking about with accounting and finance infrastructure. What would you recommend as key financial ratios for startups to pay attention to, both pre and post revenue?
That's a great question. I think oftentimes that's going to depend on what type of business that you're in. So what's your product offering? What's your target customer demographic? What's your market size? Those types of things. So, if you're a SaaS product or software as a service, for instance, there's a bevy of ratios that are going to be really critical to your business. Things like churn and average daily use and things like that are going to be, real critical for you to track on an ongoing basis. But it's going to be difficult for me to cover for the intents and purposes of this webinar, because the reality is every business to an extent is different. And so there's going to be, KPIs or key performance indicators that are critical to, one audience member that really doesn't matter to another audience member. I think pre-funding, it becomes a little bit easier to an extent from an accounting and finance perspective. I know I keep saying this, and to an extent I sound like a broken record, but that's fine with me. I really want people to keep an eye on the amount of cash that they have in the bank. So I wouldn't really worry too much about, your leverage, your debt to equity ratios and things like that. Make sure that you have enough money in the bank to keep the lights on so that you can continue to, create that minimum viable product, finalize your software development, whatever it might be to bring your product to market and start generating revenue. That's really what I'm concerned with at a kind of pre-funding stage. And that would be my primary recommendation, is just to make sure that you've got enough money in the bank to increase the value of your company by, bringing your software to market or having a prototype built so that you can continue to raise money and eventually, flip the switch, turn on revenue, and then, the KPIs and those critical metrics that you care about are going to change rather drastically and become more robust going down the road. So I apologize, there's not really a finite answer. The reality is there's a number of different metrics that are going to really matter to you. From a pre-funding standpoint, just don't run out of money in the bank account.
Cash is king.
Yeah, exactly.
Perfect. Thank you, Ryan.
Great. So now we're going to go on to hiring mistakes on building the right team and keeping them motivated for the success of your company. So there's a couple of bullet points that we kind of highlight here. First one, hiring slowly, identifying, interviewing, and accepting your candidates. So for any company, it's very important to find and attract the right team members for the organization. This means, though, that you may be scaling rapidly and you need the talent in the door. You shouldn't just hire the first person who walks in. Identifying that person who has the right skill sets, very important, and also having the right cultural fit for your company. So take the interviewing process very, very, take it to heart, and the background checks and everything else. Just remember that the folks that you're hiring are going to be the key assets to your company as you start to grow. And hopefully they're going to be long-term assets. So that's something that we really want to stress on. Moving on to the next point, firing quickly. Every so often we do pick rotten apples. And the important thing is to make sure you cut the cord quickly on these folks. Just cut your losses and move on from a bad hire. It's hard to do, but try to manage them effectively at first, then evaluate their performance. And to the point of just making sure you're doing right by your HR infrastructure, make sure you document everything along the way, just so that nothing comes back and bites you. But at the end of the day, if you need to move on, you need to move on. And as a startup and as a growing startup, you do need to move forward quickly. And then lastly, compensation. So this is an interesting question, just because depending on where your startup is located will really dictate what the compensation is. We've got a little bit of an equity range table for non-founders down below that you can kind of use as a base here. But my advice here is ask your peers what the going rate is for engineers, for specific talent, and all that. I know in being in Silicon Valley and working with a lot of the companies here that the rates for engineers are very high, and the opportunity to hire those folks from some of these larger companies is really hard to do. But on that note, finding talent throughout the country, it is there, and you can many times find it in other regions and at a much more competitive rate than trying to pick them in your own backyard, depending on where you are location-wise. So moving on from that, I think just as a few final thoughts, we're going to leave you with an Eric Ries Lean Startup quote here. But navigating the startup landscape can be really challenging, and hopefully by doing what we did today, you're coming away with at least a few tips and tricks to kind of avoid some of these pitfalls and some of these mistakes that we've seen in some of our clients. And I can't stress enough, obviously selfishly, an accounting partner is very important, but even more so on the legal side, having somebody in place very early on can be really key to the success of your organization and frankly save you from a lot of headache. At this time, we'd like to open it up to any questions from the audience. And if Emily or Ashley or Ryan have any final thoughts, by all means, please jump in. Jenna, do we have questions?
Yeah, can you expand on venture debt?
Sure. So as a startup company is actually raising a round of venture funding. So let's say they go out and have some well-known venture capitalists that are basically on board or behind them. Let's say big name VC comes in, it's DFJ or one of the other big guys, and gives your company $4 or $5 million in venture capital money. There's an opportunity there with some of the venture banks, as they call them, who work and basically work closely with the VCs and can actually provide some money to you in the form of debt, essentially. So you are required to pay the money back, but they're basing that debt not on, if you look at a traditional tech company, it may not have any revenues. It may be in full-on startup mode, but they have these VCs that believe in them and are writing a big check. So the bank will actually look at that, base the amount of money that they'll lend to a company on the venture capitalists that are behind them, saying, well, if these guys are throwing in $4 or $5 million, maybe we can add on a debt piece to the company as well for $1 million, $1.5 million, depending on the size of the round, and also depending on the company and the amount of risk, frankly, that the bank wants to take on. So what's nice about that is it is a loan. The rates are prime plus, and it's very low. And you're not, there's some warrants involved, but you're really not giving away a large chunk of your company to take on some of this debt. And then hopefully that gets you to your next round of funding, so you're actually not relying completely on that debt.
So the next question we have is, what are your thoughts on investment brokers, meaning people that connect a startup to funding, but request a percentage of the cash once it's invested? If this is a funding route, what is the fair percentage for the service?
Yeah, I'll take
tackle this. Great.
Sure, I'll take a first crack at this. This raises, quite a red flag, and something you have to be very careful about. And to the extent that anyone approaches you and says, I can find you some money, I want a percent of the money raised, in order to be able to take a piece of the money raised, they need to be a licensed broker dealer. And so, that should be your first question is to look them up and make sure they've got a FINRA license, and look them up on the website to make sure that they're licensed appropriately to be able to facilitate that type of transaction. So that's something you definitely need to be careful of. To the extent you have an unauthorized finder, as we call them, facilitate a transaction and money is taken in. If they are an unauthorized finder, the investors have the right to rescind the transaction, rescind the agreement, and you have to give them the money back. So something definitely to be careful of.
Perfect. If we have any other questions from the audience, please feel free to enter them in the question field.
Yeah, and I'll quickly, while we wait, expand on the answer to that last question. I think it also, thinking about seeking out additional investments and people who want to take a percentage. I think another consideration is that before you go that route, there are likely a number of people who are in your network, or those strategic business partnerships that we discussed earlier on in the webinar. There's probably people in your network or your partners, business partners, banking partners, legal partners, accounting partners, that can introduce you to some of the same people that this kind of hired gun investment broker could introduce you to. So before you go that route and you explore that as an option, I would really recommend leveraging your network and reaching out to your banking partner or reaching out to your legal partners to see if they have any ties in the VC community or in the angel community, depending on how much money you're looking to raise, so that maybe you can get that warm introduction and you can pitch that investor without ever having to pay a dollar for it. Really just leveraging the relationships that you already have. So that's something else to consider, I think, when looking for funding sources. See what you already have access to within your own network before looking towards potentially paid resources.
Sure, and Ryan, also, and sorry, to answer the second part of that question, it can range anywhere from 2 to 10%, and it depends on whether you're doing debt financing or equity financing. So there's a range depending on the type of transaction, and as always, it's a function of what the market will bear.
Perfect. It looks like those are all of our questions for now. Like I said at the beginning, a follow-up email will be sent out shortly with the link to both the video of this webinar and the slides. If you have any questions, please feel free to follow up with me by replying to the follow-up email, or you can follow up with Gadiel, Ryan, Ashley, or Emily individually. And thank you for joining us today.
Thank you.
Thanks, everyone.
Thank you.
Have a great day.